Are you the type of trader that has a hard time predicting markets far into the future? Well, if that's you, I've got the right solution. In this video, I'm going to share a very simple future strategy that only requires 2 to 3 hours of work each day. And it doesn't require you to have a daily bias. We'll cover how to find a trade idea, how to execute the idea, and proper risk management for personal or prop accounts. All right, guys, what's going on? So we're going to discuss a simple, no bias futures strategy. And this is going to be a full course. So we are going to cover a whole bunch of things. And my main focus is that this is going to be something that you can repeat day in, day out, and it only requires 2 to 3 hours each day. It doesn't require you to, predict what the market's going to do overnight. So if you like getting your sleep, you want to just come to the markets, 8:30 a.m., an hour before equities open, have your pre-market game plan put in place, just a couple hours before the session actually starts. And then you're only trading for 60 to 90 minutes, right? That's, I think, an ideal day trading strategy that doesn't require a whole lot of time. It doesn't require a whole lot of mental capital. It only requires you to focus for a very small period of time. Then you can get on with your day and do whatever you want for the rest of the day, which is the whole reason we got into trading in the first place, is that we're not glued to the screens. We're not a slave to the markets. So we will cover a few different things. First, we're going to go over time windows, so when to operate in the markets and what levels that we need to look for overnight. The trade ideation, so coming up with a trade idea regardless of what the daily bias might be telling you. So yes, there are opportunities to go short even if the daily bias is bullish. Vice versa, there are opportunities to go long if the daily bias is bearish. And the whole point of this strategy is that we're only looking to capitalize on that opening range volatility or that AM session volatility in the futures market. So after the equities opens at 9:30 a.m., there are going to be opportunities to get in sync with the market, whichever direction. Maybe you're going to try and get in sync during the manipulation leg or the expansion leg. And either or works. It really only requires you to be in the market for 1 to 2 hours. And once we're done, we can close up shop, journal our trades, and then move on to the next day or the next trading session, whenever that might be. Maybe there's some days where we just want to completely avoid the markets, which is totally fine. So we will go over trade ideation, how to find trade setups, the execution of those setups, right? What the market actually looks like when we're trying to frame this out. And then risk management for personal or prop accounts, as well as journaling and review at the end. So I will take my time to go over all these different aspects, especially if you're new to the markets, you're new to trading, and you just want a simple to follow process that doesn't require a whole lot of time. I will cover some ICT concepts here and there, but that's not the main focus of this. The main focus of this is to build a process-based system that you guys can come to the markets and operate day in, day out. And that way, you're at least removing some of the noise when you don't know what you're following. If you're following different types of strategies, you're turning day trades into swing trades, whatever the case is. So this is really just a simple system that you can come into the markets, focus an hour, 2 hours of your time. Win or lose, whatever the outcome is, you're going to journal that and then go home after the fact. So our time windows for time-based liquidity, so stop hunts, these are going to be important ranges that we're going to use when we're trying to analyze the markets when we sit down in front of our charts. So when we get to our charts in the morning, we want to make sure we're marking out our Asian session, which is 8 a.m. to midnight Eastern, and London session, which is 2 a.m. to 5 p.m. 2 a.m. to 5 a.m. Eastern. Now, we are not trading in these sessions. These sessions are really only used for liquidity. So if you really think about people that might be active in the futures markets, they're gonna use those ranges to build up liquidity on either side of the market. So we might have buy stops above old session highs, so buy stops above Asian range highs, or buy stops below Asian range lows, or London highs or London lows. So we are going to have stops in the form of market structure points in those time-based windows. So when we sit down in front of our charts at 8:30, 8 a.m., even maybe 9 a.m., you want to get to the charts half an hour early, that's fine. We might use one of these ranges to determine, all right, if they take one side of that range out, we might be going the other direction. And we'll get into a little bit more of the nuance when we get into the actual execution and what you should be looking for as far as trade ideation. Now, the following ranges will be used for our trade execution. AM session is going to be 8:30 a.m. to noon. I've seen other people, say 7 to 11. I think that time window doesn't necessarily matter because the most of our trading is going to come, after opening range, which is 9:30 to 10 to 10:30 a.m. and right around that area. So I really like trading from 950 to 1010, that macro, because it's, well, I'll talk about it in the later sections, but we're not going to be covering the PM session in this course. This is only going to be for morning session volatility, which in my opinion is the better session to trade anyways. So trade ideation, right? When we sit down in our charts and during the AM session, we only care about where the next 1 to 2 to 3 hourly candles will move. So this process does not require daily bias, as we are trading intraday sessions, and one session may display an opposing view to daily bias. Just like I mentioned, if you have a bullish bias, but when you come to the charts and you have a bearish PD array being respected, let's say there's a bearish fair value gap that we're trading into right at the open, you might want to catch a short down into a discount level before that daily bias plays out. But if we get a trade in the AM session that's opposing to that idea, I would rather take the trade that's opposing to my daily bias and take that position and be in and out of the markets within that first hour to 2 hours of that session. Because then maybe later during the PM session, that daily bias might play out. But if I have other things going on throughout the day, if I need to, attend to a family or attend to another job, let's say you're not doing this full time, or you are doing this full time and you want more time to yourself, you want more time to your family members, whatever the case is, this allows you to trade in and out of the market very quickly, get really fast feedback from the market, and then wrap things up, journal your observations, either it's a win or it's a loss, and then we can properly learn from those lessons very quickly. Whereas, if you're taking a swing trade, and this is the whole reason why ICT didn't teach swing trading in his mentorship, because the frequency of what you're learning is not as fast. So let's say if you're taking multiple trades with inside of a intra-session range, you're going to have more opportunities to learn because that feedback is way faster. You're going to get at least a trade a day out of that time window. Whereas if you're swing trading, you might only get 1 to 2 trades a month. All right. So we're just operating on a faster time frame. And when I break down the actual time windows, so when we go into the time windows, you guys are going to kind of see how I operate within that specific window. So I'm essentially breaking down, what I would deem as a weekly range or a daily range down into a 2 to 3 hour window. All right, maybe even less. So it might even be an hour and a half from 9:30 to 11. So, in this case, when we sit down our charts, right, we only care about the next hour to 2 hour to 3 hours. We don't care about anything else. All right. So in this case, we'll be treating our hourly candles as a daily candle. Now, when I started thinking about this really opened my mind to short-term trading and short-term analysis. But we have to be careful that we're not over-trading within that hourly candle. We just want to be able to find the best opportunities, right? Take our positions in the market. Whether it's a win or a loss, we're going to journal our outcomes and journal how we traded in that specific session and just close up shop and then come back the next day or the next session. All right. Our trade ideal will form when we have an idea whether the next hourly candle will take out a previous candle's high or low and deliver price to our target. So note here, in trending markets, old highs and lows are less likely to be taken. So given this, we only require a retracement at the beginning of the hour to get in sync. So if we are in a majorly trending market, don't expect to get liquidity raids. Okay, that next hour might just retrace to an old high or an old low, not take it, and then turn around. So we have to really understand if we're in a trending market or if we're in a ranging market, if there's a fair value gap resting above or below a specific high or low, so that way we can determine that next hour if we're expecting it to take out that old high or low. All right, that is very important. If we're really trying to treat our hourly candles as a daily candle, we have to understand that if I'm going to trade that 10 a.m. candle, and when we get into the execution, you're going to understand why I like using the 10 a.m. candle. We have to understand as soon as that 10 a.m. candle forms or the 9 a.m. candle forms, is it likely to run higher or lower, and is it likely to take out that old high or low, or is it likely to stop just as a retracement inside of that previous candle and then run in the same direction? That is going to be very important, and you understanding, how far am I expecting this market to trade against me to position myself, okay? Because that is the key premise of this whole trading system, is that we are trying to get in sync just in that next hour to 2 hours and hold it for, 60 to 90 minutes. All right, so when that next hourly candle forms, if I'm bullish, I needed to see a trade against me. But how far do I need to see a trade against me? That's what I'm talking about. So part of our trade ideation is to determine if we are in a ranging or a consolidating market, right? So ranging, expect old highs, lows to be purged. Trending, expect retracement only. That is key. So understand the market condition that you're in is going to help us determine where our protected highs and lows are going to be. All right, so now that we have those out of the way, so we've got our time windows out of the way, we've got trade ideation, how we form a trade idea. Next, we're going to talk about trade execution. So I like plotting our opening price at 8:30 a.m. I know some other people use different hours. They might use 7:30, they might use 9:30 equity open. To me, that doesn't necessarily matter as much. I'm just looking for some type of power of three where I can use that opening line or that opening price as my Judas swing. And I like using 8:30 just because oftentimes it lines up with news releases. So a lot of times we're going to get news at 8:30, maybe at 10 o'clock. But when it comes to 10 o'clock, I should have a clear indication of where that next 4-hour candle might go. All right, so the first 1 to 1.5 hours will be used to observe how price is forming as the session opens. So when I get to my charts at 8 or 8:30, I'm not doing anything, right? Because the equities market hasn't even opened yet. So a lot of times you might have gotten the 8:30 a.m. news candle. So on an NFP day or a day where they're releasing CPI, something like that, you're already going to have some information to work with by the time you get to equities open. Now, a lot of times the market is going to react off that news candle, and we're going to be able to understand, all right, did the manipulation already occur, or am I still waiting for a manipulation leg? Now, when we get to equities open, if the manipulation's already occurred and we've already taken out a specific range, let's say we've already taken out the Asian range low or the Asian range high or London session low or London session high, or some previous low or high that I was looking at. Could have been a previous weekly low, could have been a previous weekly high, previous daily high. You get the point. The point is that we're understanding that by the time I get to my session, has the manipulation leg already occurred? Because if it has, then I'm just trying to position myself at the equity open going into the session, 9:50 to 10:10. That next hourly candle or the next 4-hour candle is going to be so important. So note that this time has a 4-hour candle closure open, which will drive market volatility. So when I get to my trade execution window, which is typically around 9:50, 9:45, 9:50, right around that time window. So, 15 minutes in to the equities open, I'll have a really decent idea which direction the market wants to go. Maybe a little bit later, it might take me half an hour to gauge where the market might want to trade to, but I'll typically have a good idea on what that next candle wants to do. So if I get to my charts and the candle that closes at 9 a.m. is really bullish and I'm looking for that next trade, what I want to see, going from 9 to 9:30, is I want to see the market trade against me. And going into the 10 o'clock hour, I want to see the very same thing. So going into the next 4-hour candle, maybe we're going to get a bit of a retracement after the opening range. So 9:30 to 10 might provide a bit of a retracement. And then going into the next 4-hour candle, which might be, the first 30 minutes, so 10 to 10:30. Right? So we're talking about the next 4-hour candle. If I already have an indication of what that previous 4-hour candle did, now all I have to determine is this next 4-hour candle going to manipulate and take out a lower high and then run, or is it just going to retrace and then run? All right. So entry is at the open of the following hour. We are looking for the market to move against our short-term direction. An example, if we want to trade long, we need to see the hourly candle open lower. If we want to trade short, we need to see the hourly candle open higher. And I prefer using fair value gaps for entry, but any of the following can be used: turtle soups, breakers, optimal trade entries, order blocks. And then for our exit, we will exit at an opposing liquidity or inefficiency, or manage the trade based on time. So approaching 11 a.m. to 12 p.m., which is the end of session. So normally, I see a lot of people give back a lot of profits because they're holding through the lunch hour. And this is where you guys just have to get comfortable taking something off going into that lunch hour, because a lot of times you're just going to get volume that dies out pretty heavily, and then you're going to get a sharp retrace during the lunch hour, and then maybe a continuation in the PM session. So if you're in a trade, try your best to trim something, whether that's reducing your stop loss, whether that's scaling out some of your trades, so maybe you're taking partials on the trade, and look to square your positions, because we are treating this 1 to 2 to 3 hour window as our daily candle. And if we get that expansion, we have to be closing our position as it's moving in our favor. All right, we don't want to just hold on to it forever. Leave a runner if you need to, but as it's going in your favor, you need to take something off. All right, then we're going to get into risk management. So risk management, I personally prefer to have only 2 trades a day max. 1 to 2 this is on a personal account, by the way. 2 trades per day max at 1 to 2% risk per trade max. So even after a loss, I'm more likely to cut my risk in half to try and mitigate that loss than risk 2 at 2 trades at full 1% risk. So if anything, I'll take a 1.5 R loss for the day. I don't ever want to take a 2 R loss for the day or lose 2 to 4%. That's not something I'm trying to do. For a prop account, this is going to be a little bit different for futures firms. I know that the drawdown is tighter. So with futures firms, sometimes they only offer like 3 to 3.5% drawdown. I know on like Top Step, they're only offering like 4.5K, which is, it's like 1% drawn out. It's very, very tight. So, and this is on a 150K account. What is that? Let's just do the math real quick. Oops. Yeah, it's 3%. So, $4,500 on 150K account is 3%, roughly. Yep, 3%. So we don't want to risk 1%. That's not something we want to do. So what we want to do is take our drawdown limit and figure out what our max losing streak is. I've been known to have a string of 5 losers. So what I want to do is give myself even more of a cushion and don't give myself, 10 trades in a row. What I want to do is give myself 20 trades in a row. That way, if I lose 5 trades in a row, 3, 4, 5 trades in a row, it's not going to impact me where it's going to affect my decision making. So if I have let's say we have a $2,500 limit, and I want to give myself 10 or 25 trades, then I'll risk accordingly, $250 to $100. So if I risk $250, it's giving me 10 trades in a row before I blow the account. Or if I risk $100, then it's giving me 25 trades in a row. So you can play around with these numbers however you want. Just understand that when you're managing that drawdown, the easiest way that you can get more opportunities is to reduce your risk as you go further and further into drawdown, because you're buying yourself opportunities to get back. Whereas if you size up, you're giving yourself even less opportunities to get back. So getting back to break even, it can be a slow, drawn out process, but the key is here, capital preservation. You're not going for gains. If we just find a way to play defensively, overall, you're going to have a much better outcome, and overall, it's going to protect your mental equity a lot better as you're going into drawdown, and which is something that you guys can't avoid. So, I would highly recommend understand how many trades you want to give yourself as far as a losing streak before you blow the account. Journaling is a whole video topic on its own, but here are the biggest things that I focus on when I'm trying to journal and wrap things up for the day. First of all, before I even get to my charts, what I do is write out my pre-market game plan. That way I know exactly what I'm doing when I come to the screens, even if it's just on one market. That way I can focus and be dialed in and say, all right, I'm looking for longs at this level at this time. These are my expectations based on the news. Maybe news is going to drive and be a manipulator. And then I want to position myself, or maybe we've already gotten the manipulation prior to news. If we haven't gotten the manipulation prior to news, that's when I'm more likely to just sit on my hands and wait. All right. But sometimes we might have that manipulation leg prior to news. All right. That's just something that you guys are going to have to determine when you sit down in front of the charts. So pre-market game plan, I'm writing down my expectations coming into the session, how I'm feeling. Did I get enough sleep last night? Am I confident? Am I anxious? Am I sad? Or am I depressed? Am I excited? Sometimes being overly excited is not good for our trading decisions. Then trade executions, making sure that we're tagging everything that we should be tagging. That way when we come back and look at our journal, we can understand, all right, these tags are showing up consistently. I need to do something about this. So if you constantly find yourself tagging entering too early, and you see that tag constantly popping up, you should be learning how to be more patient and sitting on your hands and waiting for the right setups. If you're not doing your best to tag your trades, you're never going to be able to learn from them because you can't categorize them properly in your mind or in a journal. So how can you go back and learn from them? So when I'm tagging my emotions, these are the biggest areas that I can improve upon. So earlier in my trading career, I would have an issue with anxiety. I would put the trade on and get super anxious about the trade. And when I noticed more and more that that tag kept popping up in my trades, then I need to start focusing on it and being mindful of it, being mindful that I have anxiety sometimes when I place the trade, and doing my best to just calm down, right? Focus on my breathing. Those are things that I needed to clear up is, do breathing exercises. Something like box breathing is very simple. Breathing in, holding for a second, breathing in for a second, holding for a second, breathing out for a second, and then holding that for a second. So, breathing in, holding for a second, breathing out, holding for a second. And then you're constantly doing that process of a box, right? In and out. And, that'll slow your heart rate down. You'll be less anxious about the risk that you have on, and just be more mindful of your emotions, right? That way you're not making poor decisions based on you being anxious. Or we have confidence. That's another thing that maybe pops up. You have overconfidence. So if you're feeling overconfident, you put on too much size, that's something that you need to tag in your journal. That way you can come back and say, you know what? I'm getting way too overconfident in these market moves, and I'm oversizing and it's hurting me. Well, how can you improve upon that if you don't tag it and you don't understand it? And, maybe some days you're more confident than others. And maybe you find yourself that you're more confident on Monday. That's something that you have to, I guess, journal and become aware of, and you're not going to be able to do that unless you're tagging your trades properly. All right, then I tag my PD arrays. So oftentimes I'm using multiple PD arrays, whether that's a turtle soup, a fair value gap, OTE, breaker, order block. There might be multiple of them. So what I'm going to do is tag all of them. That way I can get at least a good statistic if I use those multiple PD arrays on how that trade actually panned out. And then not only that, but screenshots at the time of the trade and after. Because this was something that I brought to my students, was when you're taking a screenshot of your trade at the time of the trade, going back and looking at trades after the fact, even if it completely went against you, if you go back and look at those screenshots, you'll be surprised at the amount of trades that look like they're A+ setups, and you took that setup and the outcome was just a loss. But if that setup appeared 9 times out of 10, you would take that setup. That's how you know you're going to operate where you should be operating, in a proper state of mind, taking the right trades, and just letting probabilities pan out in your favor, or against you. So if I have a 50 to 60 to 70% hit rate, if I go back and look through my trades and I say, all right, well, these trades were losers, but I still followed my process the way I should have, those are still good trades in my opinion. Just because the outcome was a loss doesn't mean that it was a bad day or a bad trade. All right. And then we have, so this is our trade execution. I'll also have trade management. So trade management. So did I move my stops? Stop adjustment, scaling in or out, which is another video topic that I'll cover in a different video. So stop adjustment, scaling in and out. Those are two major things that I cover as far as trade management when I'm journaling. Did I move my stops? Did I move my stops in a proper way, or did I move them emotionally? Right? Because sometimes you might fear giving back profits and move your stop, even though it's not a logical decision. Right? There's no place where you could safely adjust your stop loss to, where the market might not come and take you out. All right, so we need to see some type of market structure, or maybe another fair value gap that forms for us to be able to adjust our stop or scale in and out of our trades. Post-market review. What did I do right? What did I do wrong? And where can I improve? These are very, very important for you to get on the right track and track in the right direction. So if you want to have your trading career growth track in the right direction, upward, right, you need to be able to write these things down, right, and improve on them then the next day. So the whole point of post-market review is that tomorrow you're just trying to be 1% better. That doesn't mean that you're going to be extremely good the following day, all right? That just means that, if you were too quick to move your stop, maybe the next time you're just a little bit slower when it comes to moving your stop. You know, thinking more slowly, thinking more logically, and improving that way. And then over time, those small improvements will compound. It's the compound effect, right? It's just like in trading capital. Making those small adjustments will compound over time, and you will see much larger results over time if you're tracking the right things. All right, so let's go through the process from start to finish. And first of all, you know, what we're going to do is determine the direction for the next 1 to 2 to 3 hourly candles. Right? If the direction cannot be determined, like let's say if we come to our charts in the morning and we have no idea which direction this market is going to trade to, you can't even determine, you know, what the next hour is going to do, or let alone the next 15 minutes, then you should have no trade. That doesn't mean that we have to close our charts and walk away. Maybe we're going to wait till, I don't know, 11, and then maybe from 11 to 12 we get a trade, right? Because there is that overlap on the next hourly candle. So let's say if we miss a trade at 10 a.m., right, after the opening range, well, maybe there's another opportunity at 11, right? If we don't get either of those, then I'm more likely to then turn the screens off and then do something else. But we really need to have some type of direction. So we do have some type of bias, I would say, but it's not a daily bias, all right? So the key thing is just having some decent direction idea on which way the market is going to go, up or down, right? If it can't be determined, then we don't have a trade, all right? If it can be determined, then we have to figure out, is the market trending or is it range bound? So if the market is trending, we should only expect a retracement of the next hourly candle in the first 15 to 30 minutes. So what does that mean? It means once we get that hourly candle closure at 10 a.m., you know, we have our opening range pretty much out of the way. We have to determine, is that next hourly candle going to trade higher or lower? And if it's going to trade higher, I want to see the first 15 to 30 minutes trade against me. So that means if I'm going to place my trade at, say, 10:05, 10:15, 10:10, around that area, 10:20 maybe, 10:30, I need to see that first half of that next hourly candle trading lower to some level that I can enter in and go long, okay? So that might be a short-term low, it might be a fair value gap, it might be a breaker, it might be OTE. It just needs to provide some type of retracement. I'm not looking for old lows to be taken out. That's the difference between a trending market and a ranging market. And the example that I'm going to show you guys was that's coming in a couple minutes is going to be a range-bound condition. Now, I'm not going to give you guys too many examples. I'm just going to go over one example, and it's going to be your homework to go and find setups like this. And going forward, you know, leave a comment if you're following this process to a T each day. You know, I'd love to see you guys posting some results or some scorecards, you know, how you operated today, how you operated the following day, you know, or how you operated the week, and how this model is changing the way you're thinking about trading. So if we're in a range-bound market, though, I'm expecting some type of liquidity raid prior to of a prior hourly candle, right? So it doesn't have to be the candle that formed right before this one. It could be a candle that formed, you know, a couple hours ago, right? That could be the Asian session ranges, or it could be London session ranges, or it could be a previous day, previous week, previous month. One of those ranges is going to be rated. All right, that's a range-bound condition. Whereas trending, you know, we don't necessarily need to see a liquidity raid. It's nice to see on a short-term time frame, but it's not required. All right, so our entry, right, with our specific entry model is any combination of fair value gap, turtle soup, breaker, OTE, order block, etc. So within those 2 to 3 hourly candles, and I have a whole nother video that I'm going to talk about, you know, how you're finding these different concepts within 1 to 2 to 3 hourly candles, right? All these concepts will tie into each other once you understand, you know, I guess the code of the market, how the market is actually moving and how these candles are actually printing. So when we find our entry, right, using any combination of these, we're looking to get that expansion on that hourly candle. And if it expands in our direction, but it hasn't yet reached a target, that's your key indication to maybe hold for another hour. Or you could trim something off at the top of the hour, right? So maybe if you're trading from 10 to 11, trim 25 to 50 to 75% of your position on. And if it hasn't reached that higher time frame target, leave a little bit on to run for noon, okay? So we are going to exit at opposing liquidity or inefficiency or nearing the end of a trading session window. Then we're going to journal the session win or the loss. All right. So before I get into the chart examples, let's kind of run back over everything that we covered from start to finish. All right, so we covered time windows, understanding that these time-based liquidities, as well as all of these extra ones, right? We have previous monthly highs and lows, previous weekly highs and lows, previous daily highs and lows. And not only do we have these, but we also have inefficiencies that we need to pay attention to. So fair value gaps, daily fair value gaps, weekly fair value gaps, volume imbalances, or NWOGs and NDOGs, which are new week opening gaps and new day opening gaps. So we should write those out as well. So any of these, right, will be our time-based windows where we have to pay attention to. So, any of these that's what we're gonna look for in our time window to see if we get a run on any of these liquidity levels. Our execution is anywhere between 8:30 a.m. to noon. Now, like I mentioned, I'm mostly operating, after the first 15 minutes of the equity open. So the first 15 minutes, I kind of chalk that up as just information. I'm just observing, and then going into the next hourly candle. That's kind of when I'm trying to operate between 9:45 to 10:15. That's the window that I'm really trying to operate. Trade ideation, right? We have to understand we are only looking for the next 1 to 2 to 3 hours. We're treating that as our daily candle, right? We're trying to form our idea based on those next hourly candles. In trending markets, old highs and lows are less likely to be taken. So given this, we only require retracement at the beginning of the hour to get in sync. So part of our trade ideation is determine if we are ranging or in a consolidating market. I'll go over 2 examples actually, just in NASDAQ, and that way it kind of gives you guys a good base of what you would look for going from 9 to 10 to 11 a.m. So our trade execution, like I mentioned, any combination of these inside of the first first half of the next candle, right? So the first 1.5 hours is just for observation, from 8:30 to 9 a.m. All the way up till 10 a.m. is just observation. You're not trying to operate within those time windows, all right? Unless something is very, very clear at the 8:30 hour because we have news, all right? So exit, right? We're gonna exit at opposing liquidity or inefficiency, or manage the trade based on time. So as we're approaching 11 to 12 p.m., 11 a.m. to 12 p.m., we're trying to trim our position and take something off, reduce our risk, whatever the case. You guys can choose. You can either reduce your stop loss or take a partial. I prefer to do both, right? So that way, if the market does retrace on me, I don't have a full position on, and I have my stop moved up. So, and obviously, if it doesn't move in your favor, then you should just take a full stop on the day and then just be done, because our hourly idea did not pan out. There's always another trade around the corner. Don't try and push too hard. Journaling, right? So we talked about risk management already. 2 trades per day max. So I'm talking about 1R. Doesn't matter what percentage you want to use. Some people like that trade a little bit bigger. Maybe they're risking 5% of their personal account. You don't have to be that guy, but there are people that are doing that. Just think about trades in terms of R value. Okay, so you never want to lose more than 1.5 R per day, in my opinion. If you take 2R losses, if you take a 2R loss on the day, that's 2 full-size positions that you really don't want to take on your account. All right. So understand what your max losing streak is if you're trading prop firms, and just divide that drawdown number, that drawdown limit by the amount of trades that you want to give yourself. Journaling, I talked about the exact things that we should journal as far as the pre-market game plan, tagging everything, your PD arrays, screenshots as well, and then trade management, post-market review. These are all things that you guys should cover in your journal. Make sure you're doing this and make sure you're reflecting on it at the end of the day. And the bonus of having a short-term trading system like this is that you're getting very fast feedback. So instead of waiting for feedback, let's say if I'm taking a swing trade, I might not get the feedback until a week from now, all right? Whereas this model, I can get feedback at the end of the session. So I can journal all my trades and be done and reflect on all of that before lunchtime, all right? That's the bonus of being able to execute in a short period of time. All right, so again, we went over all of this. Have your invalidation, right? So understanding if we have a direction for the next 1 to 2, 3 hourly candles, right? Then we figure out, is the market trending or range bound, and then operating based on that. So if it's range bound, we're looking for turtle soups most of the time. You're not really looking for fair value gaps. You're looking for a turtle soup set up at some point. Whether the fair value gap forms after the fact, that's fine. But in a range-bound environment, you're looking for that liquidity to be rated first. Trading environment, not so much. All right. So let's go over a quick trade review. This actually happened today on NASDAQ. So what I did was, when I came to the markets at 8:30, 9, I'm looking at our market. So right now we have a range-bound market. All right. So this is a range-bound market, and we're trading inside of this daily fair value gap. So this is a larger daily fair value gap they're trading into. So you guys can see consequent encroachment here. All right. So we have consequent encroachment of that daily fair value gap. And when I got to the charts, we did not quite yet have a run on liquidity. So prior to the 10 a.m. news, we had 10 a.m. news come out. All right. And then at the 9:30 open, we ran above. And we didn't quite take out Asian range highs, but we were close. So what I was looking for, because I had a bullish bias, was I was looking for a run on some type of sell-side liquidity. Now, when we got this run on this swing low right here, that's my indication that now we've taken out liquidity and we should start looking for trades in the opposing direction. So if we didn't have the manipulation like lower, right, I needed to see some type of liquidity being taken out. And this is the difference between trading markets and range-bound markets. So you guys can see over here, these are my hourly candles. And when we're in a range-bound market, I need to see some low be taken out. So coming into 10 a.m., right, it's 10 a.m. we had news. We had 3 lows that had not been taken out. So we had this one, and this one. Right? That is, to me, is very susceptible. And in a range-bound market, I need to see sell-side liquidity purged. So my sell-side liquidity is either going to come in the form of this low, or this low. So any of the previous 3 hourly candles is going to be my rate on liquidity. So 10 a.m. actually provided that run on liquidity. So you guys can see this is the close of the 9 a.m. candle. So this is the close of the 9 a.m. candle. We took out this buy-side liquidity. I don't have a trade yet, so we're up here. You guys can see that these prices line up. So this hourly candle is depicting this hour. So you guys can see this. This is 9:30 to 10. So 10 a.m. closed here. You guys can see the 10 a.m. news sent price below the sell side liquidity. So after we've taken out that previous hourly sell side liquidity, this is my range bound condition I'm looking for, my turtle soup. Right now I have my turtle soup. Then I'm looking for a change in order flow. And I get that change in order flow after this buy side imbalance is created. So not only that, we have a retracement into, this is most likely, optimal trade entry. So if I miss that one, then I have a market structure shift here, and then another fair value gap entry here. All right, and you guys can look at the time windows when I'm trying to operate in the market, because this is the formation of the next 4-hour candle as well. If you guys check the 4-hour chart, you guys can see that, that's the window that I'm trying to operate in. I'm trying to operate in that 9:50 to 10:10 window where that new 4-hour candle is forming. So after I got that rate on liquidity, we're just looking for a change in the state of delivery. So we go from, a massive sell side delivery. When do I get that inversion? Maybe this is an early entry, but once we get a closure back above it, well, all right, maybe this becomes our market structure shift then. And then now we're using this leg in here as our retracement. So we have this low, this high, and then this retracement into this fair value gap is then our OTE. All right, so you guys can see this swing. Now we have this retracement into OTE with a run on that, lower time frame low. I believe this is a 1-minute chart. So you're going to get 60 candles within that next candle. And you guys can see that leading up into the next hour, this candle closes at 11. So what I'm doing is I am plotting out my hourly markers. I don't need to necessarily do this while I'm trading, but just as a depiction, you guys can see how that hourly candle formed over here. All right, so this is your hourly open. And if you're trying to go long, you're trying to go long below the open, right, as a power of 3, and then closing when we get towards an opposing liquidity level. And maybe you want to trim some up here, and it's not quite yet at this 1-hour fair value gap. That's fine if you want to trim some here or here or here, because we are above these short-term highs, right? Every time we punch above a short-term high like that, maybe you want to just take something off. All right, but this is just one example of, how you would trade this specific model, because we only care about what occurs between 10 a.m. and 11. And I'm going to come in here and mark up everything that I'm seeing as far as market structure shifts, breakers, whatever you want to name it, or however you're gonna mark up your charts as far as lipstick. I would come in here, take a screenshot of what this market actually did within this window, put it in my journal, and then just be done for the day. All right, and that's it. You're done. If you get it wrong, you get it wrong. You know, maybe you're gonna extend this to 2 hours after the fact. So within that 2 hour window, you're gonna mark out all the price action that you saw. You know, and then maybe you hold it for too long, and then you saw some of these fair value gaps failing, right? And some of the order flow changing. So you see this fair value gap, it inverts. And then when you see this, right, that's just something that you guys can study and just say, all right, well, I exited too late. Let's say if you held on for too long and you let this hourly candle, after it hit your 1 hour fair value gap, you guys can see this next hourly candle retraced all the way against us. That's a mistake where you just have to be sharper and you have to be faster in exiting. And this is why short-term trading, you have to be more nimble than you would be with swing trading. You have to be able to exit faster. You have to be able to think faster. And that's why it doesn't suit everybody. But if you're a fast thinker and you like trading this way, you like getting quick feedback, then this is the best way to do it, right? Just trying to trade the next hour to 2 hour to 3 hourly candles. And my recommendation is, you know, typically if you're going through high volume levels, like let's say even if you were long on the 9 a.m. candle closing at 10, you could have traded the opening range, right, from 9:30. So this is our 9:30 open, by the way. This is our 9:30 open. You could have traded long at this order block and just went long here, right? Because this is our OTE. Maybe this is the market structure shift that you're looking for. This is your OTE, and then you're exiting before that next hourly candle. If you're a short-term trader, I really like exiting partials before the next hour closes. You know, before that hourly candle that I'm operating in closes, because sometimes we don't know where that next hourly candle is going to do. And if you want to get back in the trade, you can get back in the trade. But I'd rather do that than seeing you know, something like this happen, where the 10 a.m. especially if you have news at 10 a.m. All right, but you guys can see that, you know, it's just marking out all this information inside of that one specific hourly window. Now I'm going to bring up one more example, which was our short position that would have occurred yesterday in NASDAQ. Let me just make this smaller. So this is another example where if you come to the charts at 9 a.m., 10 a.m., this candle right here closed at 10 a.m. So it already gave us the indication that it's rejecting away from the fair value gap. So what we're looking for is just a small retracement at the beginning of the hour. Now, inside of that small retracement, we might not have gotten anything. All right. So if we didn't get any major retracement, and the retracement really honestly occurred in the first like minute to 2 minutes. All right. So this first retracement after the 10 a.m. close, so that 10 a.m. candle closed, we're just looking for some type of retracement. You know, we have a fair value gap up here that we possibly could have put our stop loss at, right? And then maybe we're using this as our swing. So let me just draw out a Fibonacci retracement right here. Right, this right here to start the hour is just we're trading up into our OTE level, and then you're just gonna go short there based on that quick run. But honestly, maybe you just completely missed that move. But this is just another example where, you know, if that hourly candle is showing you what direction it wants to trade to, then we're only going in that direction, right? Very similar situations in here where we're just trying to depict where the next couple hours are going to go. So if we get this run here, even during PM session, now I didn't cover PM session, but if you're looking for a direction on the day, you're just looking for, you know, a run on liquidity. This is our range bound condition, by the way. So we're in a range bound condition. So even at the open, this is our candle that closed at 10 a.m. The next candle opens, and we're looking for some run higher or lower. So if you were short biased, you're looking for that run higher there to get in sync with the market. All right, so here is our run higher. So this is 950. You guys can see 950, 955, 10 a.m. So now we have a new 4 hour candle, and then we're looking for indications for this market to turn around. And we have this possible turtle soup here. And we have a fair value gap that lines up with it over here. All right, so I hope this was very insightful, and I'll see you guys in the next one. If you enjoyed this free strategy but want to learn directly with me in a hands-on environment, make sure you book a call using the link in the description. I've helped students like Dom, Mike, and Nick turn their trading around and receive their first payouts. Don't forget to drop a comment, like, subscribe to the channel, and I'll see you guys in the next video.